One tax strategy that's popular amongst entrepreneurs who are planning for an exit from their company is to leave the high tax jurisdiction that they're living in and change their residency to a low tax jurisdiction or jurisdiction that doesn't have capital gains taxes so that they can save the tax on the capital gain on the exit from the company. Now, for some people, like Americans, this is impossible due to citizenship-based taxation. It doesn't matter where you move and exit, you're still paying capital gains tax. At the very most, you can change your residency from a state with capital gains taxes to a state with no capital gains taxes, but forget about it internationally.
Welcome to the Wealth Uncensored podcast, straight talk about everything that impacts your wealth. In each episode, I share what I've learned through my own experience and 2 decades of helping high net worth clients structure their affairs to minimize taxes and protect their assets for the next generation. I'll also feature special guests who are experts in their own field, sharing their knowledge and experience to help you protect what's yours. I'm your host, Jimmy Sexton. Let's dive into today's show.
For the rest of the entrepreneurs, it's often possible that if you relocate from the high tax country you're in to a low tax country, that you would be able to then liquidate your shares without having to pay any capital gains tax on it, so long as the country that you move to doesn't have capital gains taxes. But there's a couple of things to consider. This strategy, while it does work, takes a little bit of advanced planning, and you can't just move like 2 days before you sell your company. So if you're planning on doing this, the very first thing that you need to do is consider, does your country have an exit tax? Some countries have an exit tax that says if you leave, you have to pay taxes on your unrealized capital gains. Or some countries say, if you leave the country, that maybe there's a leash on you for a few years that you continue to have to pay tax in that country. So the very first thing you need to do is determine what the tax consequences, if any, are going to be from leaving tax residency in the country where you're currently residing. The next thing you need to do is see how the country where you're currently a tax resident taxes capital gains. Because it is possible that even if you leave that country and move somewhere else, that country may tax gains on assets located in that country. So let's say, for example, your company's in country A, you live in country A, you now leave country A and change your residency to country B that does not have capital gains taxes. It's possible that country A will say it doesn't matter where you live, gains recognized on the sale of shares within country A are going to be subject to capital gains taxes in country A. Let's assume for a second that you've determined that you can leave your country of current residence without any tax consequences or with tax consequences that are acceptable to you, and that country does not tax capital gains of non-residents. Then the next thing you need to do is choose where you're going to go. So not all countries are created equal. So a lot of people might be familiar with the Italy flat tax regime. But Italy has a rule that if you liquidate shares in a private company within the first 5 years, that you have to pay taxes on it in Italy, unless you have a tax ruling saying otherwise. So you need to make sure that whatever country you're changing residency to is not going to tax the capital gain on the sale of those shares. The other thing that you need to do is make sure that there's not going to be any withholding tax on the sale of the shares. Sometimes some countries charge withholding taxes on capital gains. So you want to make sure that the country that you left does not charge withholding taxes on capital gains. And you want to make sure that the country that you're moving to is also not going to tax those capital gains. Then the next thing you need to do is plan your exit. So you can't just leave one country today, be a resident of a different country the next day, and then sell your shares. You have to formally break your residency in your current country of residence. So you need to make sure that you're very clear on what is required to terminate your tax residency in your current country of tax residence. And this may require you to be outside of that country for a while. And which tax year you leave in also plays a role. It's possible that if let's say you're already a tax resident for 2024, if you leave in 2024, you're likely going to be a tax resident for all of 2024, and it's not going to matter if you sell your shares at the end of 2024 in another country that doesn't have capital gains taxes, your original country is still going to tax it because you met the tax residency requirements for the year. So you need to plan your exit carefully. So let's say, for example, you were planning an exit in 2025. You would want to, that you exit in 2024, formally cease your tax residence and your residence in your current country, and move to your new country before the end of 2024, and then make sure that you don't meet the residency requirements in your old country in 2025 or any other country that's going to tax the capital gain. And this is another area that you really have to pay attention to, because many countries will say, they put limitations. They say if you cease tax residency, let's say in 2024, if you spend a certain amount of days in the country in 2025, you're going to be taxed as a tax resident here. Other countries also require that you have to stay out of the country for a certain amount of time before you can become a tax resident again. So let's say, for example, they say, okay, if you move back to this country within 5 years, then we're going to pretend like you never left. Or if you move back to this country in 2 years. So this is a viable strategy. It does work, but you have to plan it out properly. Step one is, like I said, verify what the tax consequences are of ceasing your residency and leaving. Make sure that there are none, or at least those that do exist are acceptable to you, and then formally terminate your tax residency. Number two, make sure that country does not tax the capital gains of non-residents. And then you need to firmly establish residency somewhere else. You can't just be like a nomad without residency somewhere. Like, you need to go somewhere. You need to get legal residency there. You need to stay there long enough that you become a tax resident. You need to make sure your center of vital interests are there so that nobody can question that this is your place of residence or tax residence for purposes of these capital gains. And then if you do want to go back to your original country at some point, you need to be clear on what those rules are, how long you have to stay out of that country before you can eventually go back. Now, one of the things that you also have to consider is, how long is it going to take you to set up tax residency in this new country that you want to go to? So, for example, here in the UAE where I live, you could probably do it in about 30 days or less. If you wanted to go to Singapore, for example, you're probably looking at 4 to 6 months. Places like Switzerland is also going to take several months, but Italy's relatively quick. You do need to plan for this, that it's going to take time for you to first get legal residency, and then you have to spend enough time there to become a tax resident, because having legal right to reside somewhere is different from being a tax resident somewhere. So in the UAE, for example, you can get legal residency and come here one time every 6 months, and you have the legal right to reside here, but that doesn't make you a tax resident. To be a tax resident here, you have to spend at least 90 days and not more than 180, 183 days somewhere else. And there's other countries that have similar requirements to become a tax resident. So you do need to plan this fairly far in advance, because you need time to get legal residency in another country, and then you have to spend enough time in that country to become a tax resident and having terminated your old residency before you liquidate your shares in a tax-free manner. The reason I bring this up is I've gotten some questions from clients lately, and they're interested in this strategy. They all don't want to make the move until right beforehand, because if they're not going to have an exit, they don't want to leave. That's not viable. This takes time to plan. It takes time to put in place. You have to live it for a while. If you want to implement this strategy, you need to just go for it. You can't wait until the 11th hour to do it. You need to plan it in advance and be confident in the exit. The exit might not go through. It may have been wasted money, but that's much better than an exit going through and you not having done this properly and taking the time to set it up properly and then being subject to tax when you weren't expecting it. Anyway, I hope you found this video informational. Stay tuned for future episodes.
Thank you for joining me on Wealth Uncensored, where we help you minimize taxes and protect your wealth for the next generation. If you like our show, be sure to subscribe and leave a review. And if you have any questions or suggestions for future episodes, we'd love to hear from you. You can email us at info@esquiregroup.com. And don't forget to visit Esquire Group's website for more information on how we can help you secure your wealth. I'll be dropping knowledge again next week. Don't forget to join us.